Welcome to this explainer. Look, if you've ever sat in a planning meeting and felt like healthcare administrators were speaking a completely different language, you are definitely not alone. Today we're taking a really fascinating journey through the specific lexicon of healthcare finance. We're going to take all that dense, textbook-level jargon of financial management and translate it into a clear, dynamic glossary. By the time we finish looking at terms like capitation, working capital, or fund financing, you're going to know exactly what is going on behind the scenes.
To make sense of all this terminology, we're going to break our tour down into 6 quick buckets: decoding financial management, daily working capital, healthcare payment terminology, valuing the future, the lexicon of risk, and finally, debt and equity financing. Let's jump right in.
First up, Section 1, Decoding Financial Management, and the major shift from mere bookkeeping to high-level strategy. Before the 1960s, finance and healthcare, and really most other industries, was pretty much just descriptive bookkeeping. The marketing folks would project patient demand, the facilities team would say what buildings they needed, and finance would just go find the money to pay for it. But today, it's a totally different ballgame. Now we use the term capital finance. This shifts the focus entirely to maximizing an organization's value and efficiency. It's a decision science. Financial managers are no longer just keeping score in the background. They are actively planning for, acquiring, and utilizing funds to steer the entire enterprise forward.
And this modern discipline basically rests on 6 core functions. We've got evaluation and planning, making long-term investment decisions like buying huge new pieces of equipment, and making financing decisions about using internal versus external funds. It also includes working capital management, contract management with insurers, and controlling financial risk. Honestly, every single piece of jargon we're going to cover today stems directly from one of these 6 pillars. All right, let's zoom in on Section 2, daily working capital, which is really the vocabulary of daily operations.
So, whenever you hear the phrase working capital, we are talking strictly about the short term. These are the immediate assets needed to literally keep the lights on in the clinic running. Working capital management means handling the cash in the bank, the marketable securities, the receivables from patients, and your physical inventories of medical supplies. If an organization fumbles its short-term assets, operational effectiveness just plummets and costs skyrocket. It's a daily, active process.
Moving right along to Section 3, Healthcare Payment Terminology, and how we actually reimburse providers.
This is a massive one. You'll constantly hear the contrast between fee-for-service and capitation. Traditional fee-for-service is your conventional reimbursement. Providers get paid for every single individual patient encounter. Every test, every visit generates a fee. But on the flip side, we have capitation. Driven by frameworks like the Affordable Care Act, capitation introduces alternative payment models heavily focused on service quality and reducing overall costs. It usually comes with risk-sharing arrangements between the payer and the provider. It's a real game changer because it completely changes the incentive structure from just doing more things to doing the right things efficiently.
Okay, Section 4, valuing the future, and how organizations plan their investments. Here's where the jargon gets really fascinating. How do administrators talk about money they haven't even made yet? Well, because borrowing money or building new facilities involves cash flows down the road, they use a concept called time value analysis. When a hospital takes on debt, they are obligated to make future principal and interest payments. To truly understand if a massive decision makes financial sense today, you absolutely have to be able to mathematically value the money of tomorrow.
Let's look at this in action. Imagine a hospital decides to build a brand new outpatient surgery center today. That's a huge upfront investment. Then the facility actually has to get up and running for patients. Only after all of that does the investment start generating a steady series of future cash flows. Time value analysis is the specific mathematical language they use to measure whether those future cash flows will actually be worth the massive check they have to write right now.
But of course, predicting the future is never a sure thing. A new competitor could open up next door, or patient demand could shift overnight. Which naturally brings us to a huge question in our lexicon. How do we actually define financial risk?
That brings us perfectly to Section 5, the lexicon of risk and how we embrace uncertainty.
Generically, risk is just a hazard. Like, if you go skydiving, you risk physical injury. But in our glossary, a healthcare business takes a financial risk. That means there is a chance an unfavorable event will occur, specifically the chance of losing money when you invest in new diagnostic equipment or hospital beds, all in the hope of earning a positive rate of return. Financial risk is the absolute bedrock of business growth, but you have to manage it carefully.
And context is everything with this terminology. Look at the difference here. An independently operated MRI machine carries what we call standalone risk. If that one machine breaks down, the entire investment suffers. But compare that to portfolio risk. That exact same MRI machine operating inside a massive, geographically diversified portfolio of diagnostic clinics carries much less risk overall. If one clinic has a totally flat month, the others balance it out. The riskiness of an asset is completely tied to the context in which it's held.
Now, to truly measure risk, we actually have to define what a risk-free return looks like. Take a look at this highly specific number, 5.26%. This exemplifies a risk-free baseline. Imagine buying a one-year, $1,000 face value U.S. Treasury bill at a discount for $950. Because the U.S. government backs it, there is virtually a 100% probability that upon maturity in 1 year, you'll get your $1,000 back. That gives you an anticipated return of 5.26%. Because that payment is fixed by contract and practically guaranteed, it is defined in financial jargon as a riskless or risk-free investment. Every other risky healthcare investment is judged against this kind of baseline.
Finally, let's wrap up with Section 6, Debt and Equity Financing, or how we actually fund the vision.
Organizations generally rely on two major buckets for capital. On one side, we have debt financing. This is capital raised through borrowing, and it creates strict future obligations to make principal and interest payments to your lenders. On the other side is equity financing. This is just the generic term for all non-debt capital. If you're a for-profit corporation, this equity is raised through owner contributions, selling stock, or just keeping the earnings you generate.
But what if you are a not-for-profit hospital? Well, you actually toss the word equity completely out the window. Instead, your lexicon shifts and you use the term fund capital. Fund capital does the exact same non-debt job as equity, but since there are no owners buying stock, this money comes entirely from charitable contributions, grants, and retaining surplus earnings. Functionally, common stock and fund financing are doing the exact same heavy lifting. So, let's tie the whole shebang together. Now that you're fluent in this vocabulary, from capital finance down to capitation and fund capital, how are these definitions going to shape your organization's future? As new models pile more financial risk onto providers, how will you adapt? Will you rely heavily on the strict obligations of debt, or will you build out your portfolio using fund capital to construct the facilities of tomorrow? Understanding these terms isn't just about passing a finance class. It's literally about speaking the language of your organization's survival.
In a standard corporate model, revenue flows in a direct line from the consumer paying for a product to the enterprise delivering it. In healthcare, that direct pipeline does not exist. A standard business operates with a simple, singular objective: maximize shareholder wealth. Apply that objective to a modern hospital system, and the logic breaks down. Historically, hospital finance departments operated largely as compliance bureaus, churning out reports to navigate Medicare regulations. Today, that administrative role has evolved. The modern discipline is known as capital finance. It focuses on the strategic planning, acquisition, and utilization of funds to maximize the overall efficiency of the enterprise. This creates a unique tension. We are applying rigorous, profit-maximizing corporate finance logic to institutions that rarely set their own prices and do not exist to enrich shareholders. The primary reason for this disconnect is the dominant ownership structure in the industry, the not-for-profit corporation. The second structural difference is the payment architecture. Revenue does not come directly from the patient receiving care, but flows through a complex web of third-party payers. Because of these two anomalies, applying standard corporate ledger practices to a hospital will lead to catastrophic decision-making. Managers must rely on a highly specialized financial framework designed to keep these distinct organizations solvent. For a not-for-profit entity, the core financial objective is to ensure the organization maintains enough baseline viability to fulfill its charitable mission. This complicates capital budgeting. When a hospital decides to build a new pediatric wing or a specialized burn center, it has to evaluate an asset whose primary return is social good, rather than cash profit. This text outlines the specialized formula managers use to solve this: total net present value, or TNPV. This equation assesses a project by summing both its traditional financial value and its social worth. That social worth is quantified as net present social value. It requires managers to assign a rigorous dollar-term estimate to the community benefit a project will generate. The rationale is that the individuals and communities supplying the fund capital to a not-for-profit never receive a cash dividend. Their return on investment is paid entirely in this quantified social value. But this model carries a strict mathematical constraint. An individual project with a high social value can be accepted, but the aggregate financial net present value of all projects in a given period must remain non-negative. If administrators ignore this rule, social projects will systematically drain cash reserves, eventually destroying the firm's ability to operate. Accurately quantifying this community benefit is no longer an internal exercise. It is a strict regulatory necessity. Facing severe budget deficits, local and state governments are aggressively challenging the property tax exemptions of not-for-profit hospitals. Taxing these institutions could yield governments an estimated $3.5 billion in revenue. To defend their status, administrators are now forced to meticulously document the monetary value of the charity care they provide. Several states have established hard mandates. Texas requires hospitals to spend at least 4% of net patient service revenue on charity care, while other jurisdictions debate forcing payments in lieu of taxes. This creates a dual mandate. Managers must calculate the exact dollar value of social good, because failing to do so triggers crippling tax liabilities or immediate bankruptcy. Once a hospital justifies a project, it has to secure the actual funding to build it. This introduces capital structure, the critical choice of how much an organization relies on borrowed debt versus its own equity financing. An organization's capacity to take on debt is dictated by its inherent business risk and its physical asset structure. This ledger maps the mechanics of this choice through a financial scenario for a theoretical provider called SuperHealth, comparing a $200,000 all-equity structure against a 50% debt split. Regardless of how the firm is financed, first-year operations generate the exact same operating income of $50,000 for both columns. However, the levered structure requires a $10,000 annual interest payment to service the debt. This interest expense creates a tax shield, lowering the taxable income in the debt column to $40,000. When we apply a 40% tax rate to both, the all-equity firm pays $20,000 in taxes, while the debt structure pays only $16,000. After taxes, the all-equity firm walks away with $30,000 in net income. The firm using debt finishes with only $24,000. If taking on debt reduces total net income by $6,000, why would a hospital choose to borrow? The answer lies in return on equity, the metric that measures how efficiently an organization deploys its internal capital. Even though net income dropped under the debt model, the required owner-supplied capital dropped proportionally more. Divide the $24,000 in profit by the smaller $100,000 equity base, and the return surges from 15% to 24%. This mathematical leverage drives asset-heavy hospitals to carry high debt-to-equity ratios. They utilize their massive brick-and-mortar facilities as loan collateral to borrow funds, magnifying the efficiency of their cash reserves. Funding the facility is only half the equation. The organization still has to generate the top-line revenue to service those loans. This continuum illustrates how healthcare revenue relies on complex reimbursement methodologies, each distributing financial risk differently between the payer and the provider. Under a per diem model, the provider receives a fixed daily payment for an inpatient stay, regardless of the actual services rendered. This places most of the risk on the payer. These daily rates are often stratified, assigning a higher payout for intensive care and a lower rate for general medical days to account for varying costs. Moving right along the gradient is per diagnosis reimbursement. Here, payment is tied to the patient's condition and the expected resources required to treat it. Medicare pioneered this approach with its diagnosis-related group system, forcing hospitals to absorb the cost overruns if a treatment requires more resources than the diagnosis dictates. Bundled pricing pushes the risk further, offering a single prospective payment that covers an entire episode of care, like a cardiac bypass, across multiple different providers. At the extreme end of this gradient is capitation. Under capitation, a provider receives a flat, periodic fee for each enrolled patient. This per-member per-month payment remains exactly the same whether a patient never visits the doctor or requires intense daily care. This flips the financial incentive structure. Capitation forces managers to aggressively control their working capital and prioritize preventive health to avoid massive financial exposure. The system is now modified by value-based purchasing, an initiative that decreases base Medicare reimbursements universally to fund incentive payments for high-quality care. Generating revenue in this environment is not a matter of driving up sales volume. It requires contractually managing the financial risk that payers continuously shift onto the providers. This diagram illustrates the complete operational reality of the modern healthcare manager. Administrators optimize revenue constrained by risk-heavy contracts, leverage that income to secure debt capital, and deploy those funds into projects evaluated largely on the social return they generate. To monitor the stability of this delicate ecosystem, managers and lenders rely on a diagnostic process known as financial condition analysis. This begins with financial statement analysis, evaluating traditional corporate data points like total assets, receivables, and operating costs. It then incorporates operating indicator analysis to measure the physical realities of the hospital, tracking metrics like length of stay, occupancy rates, and labor productivity. Finally, supplementary techniques like economic value-added analysis provide context on how effectively the organization is utilizing its capital. Healthcare financial management is an exceptionally specialized decision science. Mastering it requires looking past standard accounting ledgers and understanding the structural anomalies that govern how capital moves through the system.